Welcome to a video on the income statement, and specifically we're going to show you the end product. When we make an income statement, what does it look like? What are we after? And then in the next few videos we'll actually make a few. Here's targets. And we in an earlier video when we looked at the financial statements in general, you saw some of this, and there's still a little residual of my notes. One, I emphasize that these numbers are in millions. What I didn't emphasize, but I should have, I actually said a little bit incorrectly, is 2023 consisted of 53 weeks compared to 52 weeks in 22 and 21. So there is a little bit of non-comparability. Target had a few more days of selling in fiscal 2023. And remember also that fiscal 2023 is actually the year ended February 3, 2024. That's what they call their fiscal 23. And most of the months were in 23, including the holiday season was in 2023. So you have both back to school season and the holiday season, two huge sales times, all in the same fiscal year. That's what why they select that rather odd fiscal year end date. Okay. Let me make this look a little better for you. It's more pleasant to look at. All right. So let's look at fiscal 2023 here. Now, first, notice what kind of income statement do we have here? Do we have a single step format or a multiple step format? And the answer is we have a multiple step format, because there is operating income. There is the non-operating income section. Writing a note here, and I'll show you in a second. We have a 1 here, and that's cross-referenced. So this is the non-operating income and expense items. So this is the operating income before taxes. That's the non-operating items. And this is net income before taxes. So we have a multiple step here. A lot of retailers will have another step, and that's gross profit, which would have been sales minus cost of sales. Target chooses not to do that. So it isn't as classic a multiple step, but it's a multiple step given that it has operating income and not operating income broken out as well as the taxes. Okay, so we have a multiple step income statement, and it starts with the revenues. And there's generally two types. There's the sales and then the other revenue. And again, we could look at the footnotes to see what's in those, and indeed how they break out. And then we have the expenses. There's the 77,736,000,000 is the cost to Target of the goods that they sold to us for $105,803,000,000. So if you want to see what the average profit gross that Target makes, how much they mark their products up, you can divide, and I'll do it right here. I'm dividing, 105,803 divided by 77736, and that number is 1.36106. That means that there's a roughly 36% markup from their cost in general. So what that means is that if you walked into Target and you bought a random basket of items, maybe you bought some batteries and some ladies' jeans and some men's shoes and some diapers and some furniture and some food, etc. In general, the markup is on average 36%. Now, keep in mind this, and this is why with a footnote will break it out more, that the gross profit margin on food is going to be a lot less than on things like the furniture. So that's an average, but that's always interesting to see. Okay. There's the other expenses, the selling general administrative expenses. That's a very common line. What that represents is all of the expenses Target incurred to develop the sale, develop the customers, and service them. So this is the advertising on the TV and radio, the advertising on the internet, the advertising in the newspapers, the customer service personnel in the stores. All of those expenses necessary to develop the sale and service it. And then depreciation and amortization is that just like it was in our case earlier. That's the systematic expensing of the property, plant, and equipment at Target. Okay, and then so 107,412, 107,412,000,000 is total revenue. Income is 5.707 billion. That is the total revenue of 107,412 minus these three components of operating expenses. And so their income before taxes was 5.7 billion from their operating income before tax. They have a couple of non-operating items. The interest expense, they paid $502 million on their bonds. And they have net other income, and I'm sure there's a footnote to describe what that is, of $92 million. So that brings earnings before income taxes, both operating and non-operating, to $5,297,000,000, another subtotal. Taxes on that was $1.159 billion. Net income was $4.138 billion. So the taxes on those profits was $1.159 billion. And so net income was $4,138,000,000. Notice there's no discontinued operations. So Target has no discontinued operations at this time. I'm sure they have at certain times over the years. They then show that on a per share basis, which involves dividing income divided by the number of shares outstanding. So if you're a shareholder, your net income was $8.96 on each share you own. This stuff like basic earnings per share and diluted earnings per share, we'll learn a little bit about what that is in this course as well. We won't talk much about anti-dilutive shares, but you will learn all of this in Financial Accounting and Reporting 3. You'll learn exactly how Target did this. You could also look at the footnote to see the particulars of how Target made those calculations. And these are huge calculations. because it turns out that diluted earnings per share is the E in the price to earnings ratio, which is a very important measure of every company's profits. Indeed, if you look at the Wall Street Journal, it's going to show the price to earnings ratio for every company. Or if you look at the yahoo.com financial website or other financial websites, they're always going to show you price to earnings ratio. The price is the current stock price. The earnings is this diluted earnings per share over the last 12 months. So it is a very, very commonly used number. This is a very important thing that we provide, a very important metric we provide. I'm sorry, I'm putting that arrow in the wrong thing here. It's the 894. That's the E in price to earnings ratio. Okay, and that's a look at the income statement. Here's the statement of comprehensive income. Notice that it picks up where the income statement left off. The income statement at Target, you have these printed. So print these out for yourself so you have these in front of you, is $4.138 billion. And there we see it again. Make these real clear. All right. But then they have just a few items of other comprehensive income or loss items. The pension benefits liabilities, you'll learn what that is in Financial Accounting Reporting 3. And then currency translation adjustments and cash flow hedges, they had a $18 million loss. You'll learn what that is in the next time you have a course with me, Financial Accounting and Reporting 4. So the other operating comprehensive income or loss for the year was $41 million, bringing comprehensive income down from $4.138 billion to $4.097 billion. And that's comprehensive income. You'll learn more about that in upcoming courses. All right. There's the statement of financial position. And there's the statement of cash flows. Remember, well, I'll bring this down a little bit so you can see it better. Remember, the statement of cash flows has 3 sections. So first, we show the statement of cash flows for 3 years. Remember the balance sheet, we showed the amounts at the end of the last 2 years. For the periods of time statements, the statement of cash flows and the income statement, these are for the years ended. For the years fiscal 23, fiscal 22, and fiscal 2021. And it starts too. Remember that number? Net income of $4.138 billion. Then it shows all the cash flow amounts now. And the cash generated by Target was $1.576 billion. Was the net cash generated. This is, by the way, called the indirect method of preparing the statement of cash flows. There is also a direct method and the direct method is what I call the cash flow analogy to the income statement. It gives you cash from sales to customers, cash paid for the items sold, cash paid for selling, general administrative costs, etc. Okay, and then again, we have the three sections of the statement of cash flows. We have it by operating activities, investing activities, and financing activities. And then you can see that from the cash provided by operating activities was $8.621 billion, quite a bit more than the $4.138 billion reported as net income. We'll see why that is for when we prepare a statement of cash flows, both in this class in a simple form and then in Financial Accounting Reporting 2 in a full form. The cash from investing activities was a net outflow of $4.76 billion, primarily related to cash used to purchase more property and equipment. In other words, they're expanding, they're building more stores that will generate yet more profit in the future. And then for financing activities, the company used $2.285 billion. And the primary item in there is dividends paid to shareholders. Okay. And that's the statement of cash flows. Again, the key thing to get for now is that it has three sections. It shows the cash flows of the company, how cash changed over the year. It does so by the three classic activities of the business: operating, investing, and financing. We will, in an upcoming video, we will prepare a pretty simple one. And then again, in your next course, we'll prepare a more complex one. All right, and I hope you have enjoyed this quick look at the end product, what these things look like in the real world. Again, I encourage you to read them thoroughly for Target and then for a company of interest to you. You'll learn a lot about the business. Now, in upcoming videos, we're going to see how these things were prepared. Thank you for your attention and have a great day.